moving forward, I would like to introduce the biodata of our next speaker, CA Om Rajpurohit, for the deliberation of his session on ESOPs, tax implication for new age startups, corporates, and employees. CA Om Rajpurohit is a qualified chartered accountant and also completed his LLM in tax law taxation, LLB, CS, and BCom. Number of degrees, sir. He possesses rich professional experience for more than 7+ years in handling corporate and international taxation matters of domestic multinational enterprises. He has advised a number of international as well as domestic enterprises on the range of matter related to cross-border taxation and handled complex assignments pertaining to GAR evaluation, foreign tax credit rules, PE exposure, etc. He has also handled litigation for many multinational corporates and has successfully represented clients at the level of CCIT, CIT Appeals, CIT, DRP, NFAC for various matters. His views are well respected by media, which is the reason that his name is placed regularly in national dailies and top-notch online news portals, including Economic Times, Hindustan Times, Money Control, Financial Express, The Hindu, Times of India, Hindu Business Line, Bloomberg, and various others. He has worked across a wide spectrum of industries like manufacturing, hospitality, oil and gas, ITs, tour and travels, AIF, PMS, solar and wind energy, media and new broadcast, government organization and local authorities, banking sector, FMCG and e-commerce, EPC, EOUs, charitable institutions, hospitals, etc. Now I welcome CA Om Rajpurohit, and I would like to inform you that there are around 1,000 participants which we have joined through this separate online platform. So queries will be taken by me in the last 10 to 15 minutes before closing the session. So over to you, sir, for your wonderful deliberation. Sir, please unmute yourself, sir.
Thank you so much, ma'am, for your kind introduction. Thank you, Bharatji. Thank you, Nandaji, respected Nandaji. And thank you, ICAI, for giving me this opportunity to, share some valuable feedback on Esop taxation and all. So I would like to start the presentation. So this is mainly, surrounding near Essop, what is the Essop, what is the tax implication and all. So the coverage of this slide would be, so in this slide, we are going to discuss the importance of Essop in the new era. How many types of Essop, the Essop life cycle, what are the important terminologies in Essop, what are the do's and don'ts, and why it is important for startup companies, what are the income tax provisions for Essop expenses, what are the, for employer, what is the tax treatment for employees, what is tax treatment for SAR, what is SAR, and few case studies, different scenarios. So these are the main topics we are going to touch upon in this slide or this presentation. So first of all, we need to understand the importance of Essop. So in this, today's era, it is very common, and by the evolution of recent time, various startup or employees are becoming the backbone of every organization. So everyone wants to retain their employees. So Essop becoming prevalent or one of the major factor to retain the employees. So what are the main benefits of Essop? So first and the foremost importance is the employer try to retain the employees. And how it is tried? Because in addition to salary, if the company grow, so indirectly they are able to generate a net worth. So through so in that mode, not only company grow and employee also become loyal and they also wants to contribute toward the organization, because they also feel to some sense that they are kind of honor. So there is more of ownership context. So, and apart from that, in the startup, the in the package, what they do, instead of giving them salary on immediate basis, they to some extent, like 25% of salary they distribute, or they break it into an ESOP pool. Like, let's suppose the total component is 10 lakh rupees. So what they do, they do like 2.5 lakh into ESOP component, and they like postpone that component to future years. And in the alternative, they also able to get the employees for longer period. So one of the very important and most important thing is to retain the employees. So this is the importance. Now coming to the next slide. So in this slide we are going to discuss, so let me tell you, first we are going to discuss the background, what is ESOP, why it is important. Then after, we will discuss the tax treatment and all. So now in this slide we have discussed the types of ESOP. So the first type is employee stock option scheme. So this is one of the very common scheme, and it is used by most of the employer or startup. So what happened in this scheme? This is like granted in the form of new issues. What we are saying here, that in this scheme, that first the company set a pool of percentage like 10 to 15%, that may vary. So they, first of all, they decide a pool, then they it can be issued through new issue of shares, or this can also be increased of authorized capital. So this is the most common. As such, there is no restriction. What are the main condition is that if you are able to satisfy certain criteria, the vesting period or performance based criteria, then you will be eligible to receive those ESOP shares. So this is called as ESOP scheme. The second is employee stock purchase plan. So what happened? The company, the company purchase some shares from open market. It is mainly conducted by listed companies. So they purchase some shares from open market, and they give their those shares to their employees at a reduced price. So this is the other scheme. And the one more scheme is phantom stock or SAR. So SAR stands for stock appreciation right. So as such, this is not kind of scheme, but it is an alternative to ESOP scheme. This part we are going to discuss in the subsequent slide, because there are different scenarios also we have explained in the upcoming slides. So now we have discussed the types of scheme, but there are category of person who are barred from receiving the ESOP scheme. So the person, mainly promoters and person belonging to promoter group, are not eligible to get the ESOP. Director who are holding more than 10% of equity share cannot receive the ESOP. Independent director, consultants or retainers, and employees of associated company are also not permitted for ESOP. Though these persons are barred from receiving ESOP, but they can be offered the stock appreciation rights. So this is very, very, very important slide. So in this slide, we are going to discuss what is the life cycle of ESOP. So mostly we are going to cover all the terminology and all. So first, what happened? The company create the ESOP policy. So the scheme start with creation of policy. Once the policy is created, then the second step is to implement that policy. So the implementation is done by the board and shareholders approval. So necessary like ROC forms are filed and all. And once the scheme is implemented, then the first physical step is done, which is starting from the grant. Grant is nothing but the option is granted to employees wherein they are, there are various conditions mentioned in the grant letter, and in which if the employees, accomplish certain criteria of performance or completion of period, then there's one vesting period is also mentioned. So now the third point is, what is vesting? Vesting is the tenure, means if an employee is able to complete, it is not fixed period. Like if we say that if his employee complete a period of 4 years, then he will be eligible to get those shares. So this is very important. Vesting is always important, and again the vesting period may differ from position to position, or different type of pools. So but as such, there is no limitation for the what will be the tenure, but it should be at least minimum, means there should be a gap of minimum 1 year between the grant of option or the grant date and the completion of vesting. So once the period of vesting is completed, then comes the exercise period. What is exercise period? So exercise period is the period wherein if the employees are have completed their vesting period, then they can exercise their right to get the ESOP. So the as such, there is there's no proper guidance, or there can be a flexibility. What can be the exercise period? Even it has been seen, like in Paytm, the company can also postpone their exercise, means they can exercise their right at the time of when the share are going to listed, or in case of IPO, they can also get the receive their share at the time of IPO or get the shares listed. So this is mainly regarding exercise. Now coming to this next step, that is allotment. Once the SSC employee exercise their right of ESOP, then they are eligible to allot those shares. Means once they say, they come to company that now let's suppose it is like 100, we are eligible to exercise our 100 shares, then the company will have to give them or allot them the shares. So this is the difference between exercise and allotment. So in many scenario, there can be situation that the vesting period is 4 years. So let's suppose over the period of 4 years, I am eligible to get 100 shares. So there can be a situation that at the end of 1 year, you will be eligible to proportionate allotment of share. So in that case, the exercise period can be divided into 4 parts. So at the end of 1 year, it will be 25%. In second year, at the end of second year, it will be 25%, and at the end of third year or fourth year, 25% each. So in that scenario, like I said earlier, that as such, there is no restriction with respect to exercise period. But when the employee exercise their right, then the company is duty bound to allot those shares to the company. So once the company allot those shares to the employee, then the employee becomes the owner of those shares, and he can sell those shares to anyone. And prior to that, the company may during the vesting period, in case of private company or any other company, the company may put some restriction that these shares cannot be, these right cannot be sold to anyone within the company or outside company. But once the shares are allotted, the restriction become very less, and or in other words, the company may not be in a position to put some restriction in case the company got listed. So in this slide, we have just provided the legal definition. What is the employee stock option? What are the types, which we have already discussed in the last slide? And the important thing is, what is employee? To become an employee, there should be a permanent relationship of employer and employee, and only then ESOP can be issued to an employee. So this we have already discussed. What is exercise? What is exercise period? What is grant date, what is option, what is vesting. So more or less this we have already discussed what is the grant date, what is grant and all. So coming to this slide, what are the important do's and don'ts for an ESOP? So first we are going to discuss what are the important do's. So to motivate the employees or to make the ESOP scheme relevant for the employees or the company, there should be a clear understanding with respect to the value of ESOP. Means there should be, to retain the employee should also see that if is there any value which I'm getting if I, like I said earlier, that various cases or in high package salaries, let's suppose the total CTC of any particular employee is 1 crore rupees, then, or the CEO Infosys, they also receive their major part in ESOP. But to motivate the employee, he should also see that is there any value in the ESOP. So there should be clear understanding, or there should be fact that the employee also get appreciation of net worth. So first thing is there should be basic understanding, and there should be no gap, and it should not be like it should not be a false promises. The second is the ESOP scheme should be as per industry practices or market trends. Means there might be, because if the intention of the company is to retain an employee, then the scheme should be at per market rates. Like what I mean by that is that the vesting period should be genuine. It's not like that the vesting period will be like 50 years, 20 years. The vesting period should be as per market. What is the market trends for any vesting period, and what is the percentage of ESOP scheme and all. And the company should also regularly visit the program. So what happened in case of startup, the normal pool is kept as 10 to 15%. So the company, so if there is so much attrition, the company should also revisit their plan. Is it worthy, or whether the company's the valuation should be conducted at particular time, so that employees should also know that what is the value of their ESOP. And they should also provide the scheme that in case the employee wants to leave the company, or he is in need of urgent cash, then he will be in position to sell those shares and get some cash. So these are the kind of like terms and conditions which should be form part of ESOP schemes. And it is it is a thought through program. Means it is a kind of one time program, and at the time of initiation of ESOP scheme, or deciding any particular pool of an ESOP scheme, the company should thoroughly thought all the pros and cons, because there might be situation that a company may give more option, or like the pool is decided like 40 to 50%, but at that point of time the situation of company might be not good, but in future years the net worth of company may increase. But in that case the promoter may feel that the rate could have been, or the percentage of ESOP could be less. So this is the main do's. Now coming to the don'ts of ESOP. So the program, like I said earlier, the program of the ESOP scheme should be matched with the company's objective. So the scheme should also should be made in such a manner that the main intention is always, most of the time, to retain the employees or to retain the best talent available in the market. So it should not be the wasting period, or I would say the terms should not be like that if you complete any 1 year, that then you may entitled to receive your whole ESOP. What happened? The employee, after completion of 1 year, then the employees may eligible to get their ESOP converted into shares, and then they may leave the organization, which will not definitely not be the intention of organization. So this should be kept in mind while drafting an ESOP scheme. And the company, the company should make the promises or give an option, but it should not be the fraudulent intention. Means the ESOP should be implemented, and all the terms and conditions should be fair and all. It should not be it can never be to not to give any ESOP scheme. And again, in order to give the correct what is the value of those shares, the valuation should be done at frequent dates or whatever is applicable as per laws, so that the employee should also know what is the value of their ESOP scheme. So how to issue the ESOP? So first of all, the board meeting is converted, then the proposal is drafted before the general meeting, and if approved, then the company give the grant of option, wherein the vesting period, let's suppose 4 years is mentioned, and after completion of vesting, the employee will be eligible to exercise their option, and they need to intimate the employer. And once they want to exercise their right, then the company should allot those shares to the employees. So this is the procedure. So what are the vesting condition and method of valuation? So like I said earlier, the vesting condition may differ from employee to employee or his position. For higher employees, the period of vesting condition can be time based or performance based. And while drafting the ESOP scheme, these vesting condition is very important, and it is like it is also vesting period is also important from the income tax angle as well. So it should be drafted in such a manner that it should cover all the aspects. Let's suppose if employee wants to leave after a period of 3 years, or there might be situation that the employee may die during his vesting period and his proportionate vesting is completed, then what should be the situation? So these all should be part of ESOP scheme, and this should also be mentioned in the vesting condition. And now valuation, again we are going to discuss the valuation part in subsequent slide. So this is also very, very important. What are the valuation of option? So we can categorize into 3 categories. First, at the time of grant, second, at the year end, and third, at the time of allotment. This is important not only from the employee perspective, but also from the income tax perspective. First, in order to know the value of ESOP at the time of grant, the valuation is required to be conducted. But as such, there is no provision in income tax, so the valuation can be conducted by a registered valuer. Now, if I take an example that the company wants to introduce ESOP scheme, and they have initiated the process, and they have the grant date is, let's suppose 15th of August. So at that time, in order to know the value of ESOP, the company get the valuation done from a registered valuer. And one more important, the valuation is valid for only 180 days. Now we are coming at the end of year, that is, let's suppose 31st of March 2022. Now at that time, we are required to close the books of account, and we need to consider the expenses or provision, the tax treatment, which I'm going to discuss in the subsequent slide. So at that point of time, we also need to know what is the value of ESOP scheme at the end of year. So there might be increase in value or decrease in value, because in case of various startup, the value, there may be significant change in the value. So in order to know the correct value and what is the expense to be recognized in the financial statement, we again need to reevaluate at the time of end of year. So again, there is no, like in Income Tax Act, if we go by Income Tax Act, then the valuation can be conducted either by a registered valuer or a merchant banker. So these are two conditions: first at the time of grant, and the second at the time of end of particular financial year. Now the third position, which is very important, what when the valuation is to be conducted at the time of allotment. This is very important because employer is also liable to withhold the taxes at the time of allotment. So in order to know the actual value of perquisite, he should know the value of Essop. So the income tax has clarified that in this case, the valuation should be conducted only by a merchant banker as per rule 3 of the income tax rule. And the merchant banker should be category 1 of SEBI. Again, the valuation is valid for 180 days. So again, if the company wants to issue or create a new pool, then they again need to get the valuation done from a for grant date. They can be conducted by registered valuer, but at the time of allotment, it is mandatorily required to be conducted by a merchant banker only. So this is regarding valuation of option. So now we have completed the first part, which was regarding the basic background of what is Essop and all. So now this is very important, and many of my CA colleagues would have joined for this purpose or to know the tax implication. So we are going in this slide. We are going to discuss what are the tax treatment, why taxability of Essop is important, because in these current time or recent time, there are many of startups, and Essop has become a very common practice, and almost everyone, especially in startup, they give Essop, though the type of Essop may be different, but Essop is always a part of their scheme or salary component. So again, and we are going to cover the income tax coverage, whether the Essop is allowable as an expenditure, whether it is a revenue expenditure or capital expenditure. If it is a revenue expenditure, then whether TDS will be applicable. So this part is from the angle of employer. The second part is with respect to from the taxability from the employees. So for employees, when does the taxability arise? First, we need to we'll understand at the time of allotment of share, and second, at the time of sale of such share. Then we are going to discuss the tax relief for startups, and we have also covered the introduction and taxability of SAR or phantom stocks. So first, we are going to in the first part, we are going to discuss the income tax provision for Essop expenses from the employer perspective. So let me tell you, as is, there is no guidelines or clear provision with respect to allowability of Essop expenditure from employer. Though, so since as such there is no clear guidelines in Income Tax Act, then we need to rely upon the judicial precedents. So in this, for this type of expenses, there is a very famous case laws of Karnataka High Court in case of Bicon, which has provided clear guidelines. How is the treatment? What is the treatment? And what is the taxability? So in the case law, the court has clearly said that the basis of allowability, first thing is the Essop expenditure is to be treated as revenue expenditure, and accordingly it is allowable expenditure, and the basis for that is it is to be proportionately allowed on the basis of vesting period. So in case of Bicon, the court has held that expenditure on allotment of ESOP is an allowable expenditure for the income tax purpose, and it should be allowable on vesting period. What the court has held that deduction of ESOP expenditure over the vesting period is in accordance with the SEBI guidelines. Further, the primary objective of issuance of shares at discount is to earn profit by consistent services of employee. Therefore, the same cannot be treated as issue of share or short receipt of share, but it is to be treated as business expenditure. Accordingly, it will be treated as allowable expenditure. But, and one more thing, the court has also held that let's suppose the vesting period is 4 years, then let's suppose the total expenditure is 100, then the 100 will be proportionately allocated during for the period of 4 years. So accordingly 25 25 25 25 will be allocated over a period of 4 years. So this principle has also been laid down in the case law of Bicon by Karnataka High Court. So this is nothing but let me clear that we are going to this whole scenario through an illustration, which I'm going to discuss in next 2 or 3 slides. And in this slide, we have mentioned few general entries for employees. So it is nothing for like first we need to create an provision. So this is employee expense and expense account debit to ESOP outstanding, and then expense is transferred to P&L. And at the time of allotment of share, the provision has been converted into share capital, and the differential amount is transferred to security premium account. And since we are receiving some amount, and that has been debited into bank account. So now coming to the second part, since we have already discussed that it is to be treated as revenue expenditure, accordingly tax is also be withheld by the employer. So as such, there is no clarity with respect to treatment for employer, but for employee it is like ESOP or share allotment has been treated as perquisite. So accordingly, since it is to be treated as perquisite, so tax will be deducted under section 192 of the Income Tax Act, and under section it is to be perquisite under section 17. So TDS will be deducted under section 192 of the Income Tax Act. And one important thing is what is the, so there are two more important things. What is the value and what is the timing of deduction? So first we need to understand the value of perquisite. So the value of perquisite is nothing but the difference between the fair market value as on the exercise date, reducing the amount given by employee to the company. Means let's suppose if the value of share is 500 and the company is receiving 100 rupees from the employee, then the value of perquisite will be 400 rupees. Now, what is the time? The TDS is to be deducted at the time of allotment only. Prior to that, it will be transferred to P&L, but TDS will be deducted only at the time of allotment. So let us understand the whole scenario through this example. In this example, we have all like what we have discussed in the earlier slide. We have mentioned, we have tried to cover all those things. What is vesting period, what is the fair market value, what is ESOP and all. So let's suppose at the time of grant, the year was 0 and the fair market value of share was 120 rupees. Now coming at the end of first year, the value and the company, the company is recovering 20 rupees from employees. So at the end of first year, the fair market value has increased from 120 to 220. So what will be the expense recognized in financial account, like books of account, financial statement? So the value of 200 will be allocated. So the vesting period is 4 years. So the value of 200 will be equally divided into 4 parts. So 50 rupees will be expense for the first year, 50 rupees for the second year, 50 rupees for the third year, and so on. So now coming to the second year, let's suppose the value has increased from 220 to 420. So in this case, the total expense will be 420 less the value recovered, that is 20. So the total expense will be 400. So now the company has to re-evaluate or recompute the expenses to be recognized in financial statement. So 400 will be divided. 400 is the amount of total expenditure which is to be divided into four equal parts. So the expense for second year should be 100, but as you know, at the end of first year the value has been recognized only 50. So the differential amount of 50 should also be incorporated in the second year. So thereby the total so since 400 is the amount which is to be divided into 4 years, so at the end of second year the value of expense should be 200. So 150 for this year and 50 from last year. So total expenses to be recognized at the end of second year will be 200 rupees. So this is the treatment at the end of second year. So now let's suppose the value of fair market value of the share has been increased from 420 to 1020. So in this case, again, we need to recompute the calculation or re-evaluate the expenses. So the expense for the year will be 1000 will be divided into 4, that is 250 rupees. So now since we are at the end of third year, so 250 per year, that would be 750. So out of 750, since 200 we have already recognized 200 in the last year, so the differential amount of 550 should be recognized in this year, and the aggregate value of expenses, that is 550 for this year and 200 for last year. So 750 has been recognized at the end of third year. So this calculation again goes in this like 4 year. So let's suppose the value has been increased from 1020 to 2020. So again the value of perquisite, that is fair market value less exercise price, the value of perquisite is 2000 rupees. So again the 2000 is to be recognized in 4 parts, and so 4 part is like 500 per year. So but since we have already recognized 750 in the previous 3 years, so the differential 1250 will be recognized at the end of 4th year, and the aggregate expenses has been claimed for in P&L is 2000 rupees. So now this is the last part, when the employee exercise his option and he get those shares allotted. So again, let's assume the fair market value has been increased from 2020 to 2520 rupees. So again, out of 2500, 2000 value has already been recognized, and the differential of 500 will be recognized at the time of allotment, and the aggregate expenses claimed is 2500. So this is the whole treatment from this is a kind of very simple example. Practically the situation might be different, because there might be situation that few employees may left and few employees may add, and it is like we have just considered simple situation. There might be a scenario that value of share may increase or reduce, and there might be a situation that there is a huge or significant change in the value of share. Then we also need to make those adjustments, and there might be 1000 employees or 10,000 employees, so we need to prepare month on month basis expense sheet, whereby we need to adjust all the going or upcoming coming employees, and there might be situation that the vesting period also complete on first year. There might be proportionate completion of vesting period. Let's suppose the total vesting period is 4 years. Then there might be situation that at the end of first year that employee has completed 10%, 20%, 30%, and 40%, or it might be in a situation that the completion may be 25%. Means, let's suppose if an employee has given 100 shares option, there might be in the Essop scheme, there might be cases that he may given an option that if he complete 1 year, then he will be eligible to get 25% of shares at the end of first year, and after completing second year, he may get 50% of shares allotted. At the end of third year, he may get 75%. But now he may wants to leave the company, then he may get proportionate, or I would say 75% of shares. So these may be practical queries. So we need to again understand from case to case basis, and a detailed comprehensive Excel sheet need to prepare for all such scenarios. So this is more or less income tax provision with respect to Essop expenses. And like I said, the employee is required to deduct TDS at the time of allotment. So if there is proportionate allotment during at the end of first year, second year, third year, then he is required to deduct TDS on that amount on year-on-year basis. So that completes the employer part. Now we are going to discuss the employee or recipient part. So there are two situations. First, at the time of allotment, and the second event is at the time of sale of share. The first part we have already discussed. The tax is to be deducted. The tax is to be deducted on the value of perquisite. And what is the perquisite value? That is nothing but the differential amount of fair market value on the exercise date less exercise price. So again, let me clear one more time that if the fair market value on the date of allotment is 5,000 rupees and the company is recovering 500 rupees from the employees, then the value of perquisite will be 4,500. So this will form part of salary as in perquisite, but the value considered here in this case is 5,000 will be treated as cost at the time of sale of share. So let's suppose the value of perquisite is 5,000. Then when I'm going to sell those shares in 10,000 rupees, then 5,000 will be reduced. So now this part complete. Now coming to the second part, what is the tax treatment at the time of sale of share? So very simply, the differential amount of sale consideration minus fair market value will be treated as capital gain. So for capital gain, we again need to divide this scenario. Capital gain in case of listed securities, since and in case of unlisted security. So since all of you know that there are different scenarios. If the shares are listed, then the period of holding is changed. If the shares are listed, then the shares will be treated as long-term asset if the holding period is 12 months or more. And again, the tax rate will also differ if the shares is long-term or short-term. In case of long-term capital gain and listed share, the tax rate would be 10%. And one more benefit, up to rupees 1 lakh, the capital gain will be exempt. And in case of short-term capital gain, means the holding period is less than 12 months in case of listed share, then the taxable rate would be 15% under section 111A. One more, now in case of unlisted securities, the period of holding is again subject to change. For listed, the period of holding is 12 months, but for unlisted security, the period of holding, if the period of holding is 24 months or more, then the tax rate will be 20%. And if the period of holding is less than 24 months, then the tax rate will be, like a slab rate, normal slab rate. So from where the period of holding is to be calculated is also one more important thing. So as per section 242A, which talks about the period of holding, the period of holding shall be calculated from the date of allotment of shares. So this covers the tax rate or taxability for employees. So we have again discussed through or tried to discuss through an example. So at the time of grant, there is no taxability for the recipient. The second scenario is the vesting period. So let's suppose the vesting period is 4 years, 3 years. For those 4 years, there will be no tax treatment or taxability. The taxability, even after completion of vesting period, there will be no taxability. The taxability will only arise when he exercise or employee exercise his right and the company allot those shares. At that point of time, the perquisite value will be taxable. And again, what is the value of perquisite? That is the differential of fair market value less exercise price. So in this case, the value of perquisite will be treated as cost in case we are going to sell those shares. So the value of perquisite is 2520. So at the time of share, if the fair market value or the value of share is 5,000 rupees, then the capital gain will be 5,000 less 2,500. And again, this may change subject to indexation if there are different scenarios like unlisted and all. So this is also one of the very important topic. So till now we have just discussed that the employee exercises right and he receives shares. Again, what is the tax treatment? But there might be, or there are many scenarios, and it is seen in various startup as well, that what happen if the employee surrender his right, or he does not want to exercise, or he does not want to get those shares allotted. So what is the tax treatment in that cases? So first thing is, in order to tax the shares under the head perquisite, the shares need to be allotted. So taxability under the head salary arises only when the shares are allotted or transferred upon the exercise of Essop. So if the Essop is surrender, means we don't go for allotment, the same will not come under the preview of section 17(2)(6) of the Act. Hence, it will not be treated as taxable under the head salary. On the other hand, rights, it is Essop are nothing but the right, and right granted under Essop scheme are treated as capital asset under section 214 of the Act. Thus, any proceeding arises from surrendering of such rights to the company would be taxable as capital gains in the hands of employees. So if the company is Indian company, or in that case, if he surrendered the right, then the employee is not required to TDS under section 192. This is also one of the very important, and this like principle has been also discussed by Bangalore Tribunal in case of Girdhar Krishna in 2008 case law, and also Delhi Tribunal in case of Kamlesh Bahedia in 2014 case. And what is one more important thing is, what is the holding period, whether the Essop is to be treated as short term or long term. For that, we need to consider the date of grant as an relevant date. So if the grant date is like 24 months or 34 or 36 months, then that needs to be covered. So this so till now we have discussed the employer, all the what are the important for employee, normal employee. But now in this slide we are going to discuss the tax special relief to startup company. So first we need to know the meaning, what is the meaning of startup as per Income Tax Act. So this there are three conditions. The section 80 ISC talks about the definition of startup. To become a startup, the company should be, or the organization should be incorporated on or after 1st day of April 2016, but before 1st day of April 2022. This may be subject to change on budget, but till now this is the situation. The second condition is the total turnover of business does not exceed INR 100 crore during the year end. And the third is it holds the certificate of eligible business from Inter-Ministerial Board of Certification as notified by official gazette by the central government. So these are the main conditions to become a startup. So why we are discussing startup? Because Essop is for company, for startup, Essop is very, I would say, essential or part of salary component, because initially the company don't have as such huge cash flow, and also in order to motivate the employees or to retain the employees, they provide salary in the form of Essop, and they also try to give them motivation or to build an ownership status. So therefore discussing startup is very important. But this is, we have already discussed what are the biggest startup like mistakes done by startup. So I'm just going to discuss here the special incentive provided to startup with respect to Essop. So what happened, there might be situation that if the vesting period is 4 years, and there might be situation that the value of startup after completion of exercise may be very high, and there might be situation that the value perquisite is more than his total salary. So he may not be in a position to withhold such TDS or deposit the amount of TDS. So therefore, in order to provide relief to such employees and startup, the amendment was made in the budget 2022. So it has provided few benefits, which so what they have done, they have just postponed or deferred the TDS or withholding provision. So now, after the amendment, the tax liability for startup employees will arise only within the 14 days from any of the following events, whichever is earlier. So in the first condition, after the expiry of 48 months from the end of relevant assessment year in which the option was exercised, or from the date of sale of Essop shares by the SSC, or from the date of taxpayer ceasing to be employee of that particular startup. So through this amendment, it is nothing but the TDS or withholding has been deferred, so that there will be no cash flow crunch for the employees. So now, I have mentioned that we are going to discuss what is phantom stock and its taxability. So first we need to understand what is SAR, stock appreciation right, or phantom stock. So this is not, I would say this is used as an alternative to Essop scheme. So, and these, like the name suggests, the stock appreciation right, it derives its value from the appreciation of shares. So the underlying asset in this case is share. So we have discussed in earlier slide that there are persons who are barred or who are not entitled to receive Essop. But what happened in a startup and all, there might be a situation that company will not be able to give shares or Essop scheme to particular person, or there might be a situation that the company is not like in a position to pay huge sum. So what they do, instead of giving them Essop, they give them SAR or phantom stock. So what are the benefits? The recipient entitled to if the value of shares increase, simultaneously the value of SAR will also increase. And as such, there is no like clear. This is more, it is not legally defined. It is more in use as alternative. So it is type of compensation which is linked to company's share price. So in this slide, we are going to discuss what is the tax treatment for a corporate in case of SAR. So as such, there is no clear guidelines with respect to phantom stock or SAR. So the tax, let's suppose the SAR is given to, and the SAR can be given as alternative to consultant, employees who are going to send abroad, or any other person other than employees. Because for employees, we will always prefer to go by Esop scheme. But as such, in this SAR, as such, they also know that there is no connection, direct connection between the company and the that person who is receiving the phantom stock. So in compared to Esop, these are not that much beneficial in order to retain, but it is it is used as mere an alternative, so that they also to avoid the cash crunch. And further, there is, as such, there is no case law which also talks about the treatment and all. So what will happen about the treatment of expenses? So there are mainly two types of mechanism. Simply, let's suppose if I'm incurring 10,000 rupees at the end of first year, but what I will do, I will defer those expenses to 4 years, and I will give that particular person or consultant that, hey, look, I'm giving 10,000 ESOP. The value as on date is like 10,000, and it is a phantom stock. So if after the end of 4 years, if the value increases, then you may get benefit. But since I don't have cash, so therefore you may take the phantom stock. So what will happen after the end of 4 years? There are two treatment. We can treat the same as accrual basis or cash basis. So let's suppose if we treat those expenses as accrual basis, then we need to bifurcate 10,000 into 4 equal installment. That is 2,500 at the end of first year, 2,500 second year, and so on. So, but since as such there is no actual expenditure, but it is merely a provision. So the department, your tax officer may disallow those expenditures, since as such no payment was made and it is just a provision. So now in the second scenario, what I will do, after the end of 4th year, I can I can book the whole expense 10,000 at the end of 4 years. So in that case, the tax officer may say that it is see, this is prior period item, and it is also related to previous year. So I'm going to disallow the prior period 3 years expense. So what we can do, or we can guide the client, that there are few important points which need to be kept to be in mind. That first, the same should be in line with expenses, and the pay may raise an invoice for that particular year only, or the pay like this the arrangement can be made in such a manner that the expense should be booked in the final year, and invoice should also be relevant to that year only. And again, the taxability in the hands of employee or not employee, the taxability for the recipient, which may be consultant or any other person other than employee, which also dependent on his residential status, if he is non-resident or resident. So this is, so we have also discussed few practical example when SAR or phantom stock also can be given to employees. So in case of various scenario, there might be a situation that there is a two company, one is in India and the second is outside India. And let's suppose the vesting period is again 4 years, and there might be a situation that for the first 2 years, the employee may work in India and now he is to be transferred to USA. But the company in which he is transferred, it is not related, and it is completely unrelated company. But the employee may say that, look, I have already worked for you for 2 years. So give me some, give me some ESOP and you are sending me to abroad. I don't want to go. So in that scenario, since he will not remain an employee to the company, then in that case, the company may issue him phantom stock for that remaining period or equivalent value. So this is one of the scenario when phantom stock can be given to an employee or ex-employee which become consultant due to his transfer to unrelated entity. So coming to the second example, there might be a situation that employee may work 1 year in India and for 2 years to unrelated entity in USA, and this is also sent by Indian employer. And then after completing 2 years, he may come back to India and work for India. So what can be done in this scenario? At the start of 4 years, the company may give him ESOP option for 4 years, and after completion of 1 year, the company may give him equivalent value of phantom stock for remaining 3 years. And after completion of third year, when he come back to India, then the company may give him phantom stock of equivalent value of 1 year. But since we have already discussed this, since he will to be treated as new employee or fresh employee, then there should be always difference of 1 year from the grant date to vesting period. So these are the practical scenario which we can guide our client that this can be done if the employee is going abroad or coming back to India. This is one more scenario. Like, let's say the employee started to work initially in USA. There might be a situation that employee is hired in India, but he is directly sent to US entity, which is sometimes unrelated to Indian entity, and he also given option of ESOP. Then after completion of 2 years, he become employee of Indian entity. Then for the remaining period, he remains the employee of Indian company. Then for the first year, he can be given phantom stock, and for the remaining 2 years, he can be given equivalent amount or ESOP scheme. So these are the practical scenarios. So I have also tried to cover FAQs in this slide. So first is whether company is listed outside India can give ESOP to their employees in India. So yes, the Indian overseas investment rules permit foreign companies to issue a stock option under this ESOP scheme to employees or director to their Indian offices. So this is duly permitted. Second, can we give ESOP to any employee of an holding company? So the answer is again yes. The ESOP or Indian can be issued to employees whether in India or overseas, to holding companies or subsidiary company. As such, there is no condition, no restriction. So the next query is how frequently valuation is required and what is the validity of valuation report. This we have discussed in detail in our slide valuation summary. So the time period or validity of valuation is 180 days, and like I said, there are three different stages, important stages. First, at the time of grant, when we need to determine the value of option. Second, at the end of each financial year, in order to know what is the value of my expense or provision. And third, again very important, which is at the time of allotment, to know the value of perquisite in order to check my determine my TDS liability. So one more query, what is RSU, how it is different from ESPP or ESOP? RSU is more kind of similar to ESOP, normal ESOP scheme, but if RSU are stock of employer without any contribution from employee, but they are often come with certain restrictions. So if we put few restrictions which can be dependent upon you, like time period for vesting condition, or like for a particular target and all. So this is to be considered as RSU. It is more or less in renaming as one of the one of the option, and it is more common. It is considered as normal ESOP. So in ESOP, discount is given to market also. So this is like more or less it is similar to ESOP. As such, there is no difference. But if there are certain restrictions put in, then it is like it cannot be transferable. So there can be various situation or restriction which differ from case to case. So these are to be treated as RSU, restricted stock unit. So now this is very important, whether grandfathering provision with respect to long-term capital gain are available in case of ESOP. So once the employee selling ESOP of company which get listed on stock exchange after January 1st, 2018 may not get the benefit of grandfathering clause proposed in the new tax laws regime. It is likely that these ESOP sellers would have to pay 10% on long-term capital gain. For employees of company whose shares which were listed before 2018 will get the benefit of grandfathering. What we are saying is that if the shares of ESOP are listed after 2000, the cutoff date of January 31st, 2018, then they will not be eligible to get the grandfathering, benefit of grandfathering provision. But if the shares got listed before January 31st, 2018, then the benefit of grandfathering will be given to those employees. So in this FAQ, we have discussed whether company can issue a mix of normal ESOP or SAR together. So we have discussed what are the difference between ESOP and phantom stock. So normally what happens, ESOP is given to employees, and when the person, few person or category of individual who are barred, or if the company wants to give like similar to ESOP, then they give phantom stock, whom they cannot provide ESOP, like consultant or person other than employees, then they give phantom stock. But there are scenarios that in case of employees, can they give ESOP and SAR simultaneously? Then yes, there might be situation a company can issue mix of phantom stock and ESOP, and company might issue there might also be situation that company may issue, like same company have two different scenarios. They can issue ESOP to its employees, and they can issue phantom stock to consultant at the same time. And there may also be situation that the company may give some part in ESOP to a particular person and some part in phantom stock. So as such, there is no restriction in income or in company's law or income tax act. So in the next slide, we have discussed what if the FMB moves below the exercise price, how would be treatment in both sides. So ESOP provide an employee with an option to purchase shares on a future date at a predetermined price. If the FMB of shares falls below the exercise price, no employee will exercise option and option will lapse. So the company will transfer the entire expense book till the to its general. So what we understand, so in this query, what we understand that let's suppose the value of ESOP or share is 100 rupees at the time of grant, and I am the exercise price or the values to be recovered from employees 50 rupees. But due to some circumstances, the fair market value of those shares has been decreased from 100 to 30 rupees or 20 rupees or 45 rupees. So what will happen if the value of share is less than the exercise price, then no one is going to buy those shares. Means if the value is, if no one is going to pay 50 rupees for a share of 40 rupees, and then what will happen with the company? So since at the end of, let's suppose, 4 years, the company has already booked expenses in its books of account for earlier period, but the employees, practically the employee is not going to exercise his right, then the company needs to reverse all those expenses. The company needs to reverse all those expenses at the end of 4th year. So now the next query: what happened to vested and unvested option if the employee dies after the vesting period but before the exercise of ESOP? So like I said, the ESOP, the scheme of ESOP, or drafting of scheme should be made in such a manner that it should cover all such situation. And if those like ESOP scheme cover all those situations, then all the vested option as on the date of death can be exercised by the option guarantee or nominee or legal heir immediately after, but not even later than 12 months. So it means that if after completion of vesting period, the employee, due to some circumstances, the employee died or anything happened, then the legal heir may claim those shares. So this is like more of completion of, like, if anyone wants to ask any query, or Sukhjit ma'am, if you have any query, please let me know.
Yes, sir, I have two queries.
Just tell me, ma'am.
Yes, I will read it for you. The first query is how to taxability on Essop when shares issued are foreign shares. Also, in case issue of foreign company shares, some of shares are sold by company for paying foreign tax. Whether there are two transactions, one that is allotment of shares, second selling of shares for paying foreign tax. Whether second transaction required to show at income tax return.
So if I'm getting it correct, the Indian person or Indian employees has received some foreign share or foreign for shares of foreign company. Am I correct, ma'am?
The taxability he is asking about the share issued for foreign share, yeah.
So
in case of foreign company shares.
Yes, foreign shares means foreign company. So
Yeah.
So from foreign taxable, we are like in this slide, we are discussing income tax provision as per Indian tax laws. So what is the foreign tax treatment and all? That depends country to country, that depends country to country. What are the tax treatment for that particular country? But for Indian employees, what will be treatment if, let's suppose, the taxes has been withheld by that foreign company? Then he will be eligible to claim the foreign tax credit. Also need to offer those shares. First thing, it will be treated as unlisted shares because it is not listed in India anywhere. If it is not listed in India, and second, the holding period will be 24 months, and it the differential of sale minus purchase exercise price will be considered as capital gain, and the long term and short term depend upon the holding period. And if any taxes has been paid by him outside India, then he will be eligible to claim the foreign tax credit.
The next query is regarding.
And ma'am, one more thing. While he's like, even during the vesting period, he need to disclose those ESOP scheme in his AL schedule as foreign asset, not in AL schedule, in foreign asset schedule. And if the income is more than 50 lakhs, then he also, since the value may be, the value ESOP as such, at the time of ESOP, there will be no value of those ESOP. The value may be nil, but he need to disclose the name of ESOP, or like ESOP scheme, in his foreign asset schedule. The value may be considered as nil, because prior to allotment, most of the time the value of ESOP is always nil.
Shall I move to further
Yeah, ma'am. Sure.
query? And the
Yes.
next query is regarding that, sir. Is there any concept of fringe benefit tax to be charged by company in case of sale of Essop of the employee at a higher rate than the market value?
Fringe benefit, ma'am, I think there might be some perquisite because fringe benefit is already removed.
Yeah.
There might be perquisite that, yes,
There
way
is
back
no
it was
concept
already
of fringe
removed.
benefit now, sir.
Yes. You may ask whether they want to, consider that as perquisite or something else because FPT is already removed. It is way back removed in 2009-10, I guess.
Okay. I think if the
Ma'am, we can wait if he wants to, like the FBT, if he wants to more clarification. Who is asking that? You may ask him that he can again rephrase his query if you are not. And if it is just with respect to FBT, then let me clarify. Even ma'am will also agree that FBH was already removed. It is withdrawn in I would say year might be incorrect, but I think it way back in 2009-10, AY 9-10.
yeah, long back, sir.
Yes, ma'am.
Sir, I think there are no other queries. So I will now request CA Bharat ji for the vote of thanks. Bharat ji?
I hope the session was informative.
Yeah, sir. Very well, sir.
Thank you.
Yeah, ma'am.
I think there is some network issue. Bharat ji?
This is also ma'am kind of traveling time because in this time usually like people travel.
Yeah, lots of people travel. So
Yes.
that's maybe there is hope. Anyway, sir, I will thank on behalf of Hisar branch for giving such a wonderful deliberation. And I thank on behalf of Bharat Jain ji also. So thank you so much, sir,
Thank you so
for
much.
the wonderful words you have given to us. Shall I take?
Thank you, ma'am. Thank you for
Hello.
giving us opportunity. Thank you. I think we have like finished it 10 to 15 minutes earlier.
Yes,
Yes,
sir. Thank you, sir. Thank you so much.
Thank you, everyone. Thank you so much.